GM, good morning. Welcome to the Milk Road Show, the daily crypto show where the waves of uncertainty keep coming, and we left the life jackets at home. I'm your host, Jay Hamilton. It's Thursday, May the 29th. A U.S. federal court has said that Trump exceeded his authority with tariffs, bringing into question what can he do with tariffs moving forward? We're going to talk about that. What is the impact on the market? Markets are feeling a little bit this morning. It's all about government bonds at the moment. When you look at the macro global situation, government bonds, long-term yields are consistently rising. US, Japan, UK. What does that mean for us and for risk assets? And at what point do we get worried here? And do you really need to start to pay attention? And then also we got to talk about the new Trump spending bill, the big, beautiful bill. Is this good or bad for stocks and risk assets long-term? To break it all down, we're joined today by Craig Shapiro, macro strategist at the Bear Traps Report and a cross-asset portfolio manager with over 2 decades of experience in the financial markets. Before we jump in and hear from Craig, because this is Milk Road Macro, I got to tell you guys, which I've been telling you all week, we just launched the Milk Road Macro newsletter. You got to check it out. Hit the link in the show notes to subscribe today. 5 minutes in your inbox 2 times per week to give you the download in a simple way so you can actually understand macro, because it's often so much noise and not enough signal. And we're going to make sure you get the signal in your inbox. We're also looking to hire a Milk Road Macro podcast host to take over this podcast right here. So if you are a podcaster and you love to talk to macro, hit the link in the show notes and you can apply or send us a note. Today's episode is brought to you by Ledn. Get cash without selling your Bitcoin. It's also brought to you by Meanwhile, Ditch Dollars, Insure in Bitcoin. Without further ado, Craig Shapiro, welcome to the Milk Road Show.
Thanks for having me, guys. Really appreciate it.
We also got Kyle here. Kyle, I always forget to intro you. Sorry.
That's all right.
I love you, man.
That's all
Great
right.
to see you.
I'm here. Happy to be here.
Okay. Let's start with the news of the day, which is the ruling out of a federal court that Trump has exceeded his powers with tariffs. Let me just bring up Craig, your tweet here. Tariffs overruled by courts. Trump going to be hella mad. really nails it. Craig, what's your thoughts on this news and the impact it could have on the markets?
Yeah, look, I mean, obviously, tariffs have been top of mind, for quite some time, from really the beginning of this term, with the Mexico and Canada tariffs, and then, the China tariffs, the fentanyl tariffs, then Liberation Day and the markets sell off, and then the reprieve and the delay. And it's just been, kind of a nonstop barrage of headlines from Trump trying to, generate revenues to help fund tax cuts, to help restore trade balances, which are heavily in deficit for the U.S., and a variety, and bring back manufacturing jobs, right? So tariffs are a major part of the regime. But, obviously, given the unilateral nature of what he has tried to do using, historical, laws that, in order to maybe get some of his power to do this by himself, various lawsuits were filed, and it kind of collated around this case, which wasn't clear that the ruling was going to come out yesterday, but we knew it was kind of, any day. And what this trade court decided was that he's overstepped his authority to do these unilateral reciprocal tariffs, this 10% and plus depending on the country. So the court comes out yesterday and basically says, nah, he's overstepped his boundaries here. And so then the markets had a nice reaction to that overnight. Risk on, volatility selling, equities to the moon, as people kind of originally or initially think, okay, that means this is going away. But as we know, certainly with Trump being Trump and tariffs being his self-proclaimed favorite word in the English dictionary, we know it's not over yet here. And so the administration now has to think about what it's going to do next and appeal. They've already said they're going to likely to appeal. It's likely they will ask the court to stay an injunction, or so they can keep collecting tariffs while they appeal. And there's also various other things that they could do using different statutes and different sections of the law in order to put tariffs back on there. So I don't think we're out of the woods yet. I don't think tariffs are going away, but this is clearly a shot across the bow to his agenda. And look, the courts have been kind of, dealing with his agenda in different ways. And he's been, pushing back against some of the activist courts, as he claims. And so, we'll see what happens. I know there's a White House press conference coming out this afternoon, right after we're done here at 1 o'clock. So I'm sure we'll hear some questions and some commentary from him. And I suspect while we're live here, we'll probably get a Truth Social post to give his update. But yeah, some uncertainty back in the in the world of tariffs that needs to be dealt with.
What happens in the meantime? Obviously they don't just turn off today, do they? Like they're going to just stay on until we figure something out, or
yeah,
what's the ruling?
Yeah, my understanding is they have now, assuming nothing else happens, within 10 days, we have to stop collecting. The government has to stop collecting tariffs. And it's not all the tariffs. It's really just the tariffs that have been put in place since Liberation Day, these 10% extra tariffs, and the tariffs that he put in February, March on China, Mexico, and Canada for fentanyl. So those tariffs were done in ways that were different than what he did in the first term when he used Section 301 and Section 232 for sectoral tariffs and tariffs on China. Those went through the legitimate process. Those are not at issue. It's these incremental tariffs that he's added since really the beginning of the year. So within 10 days, we're supposed to stop collecting those tariffs. Now, what the administration is going to do is they're going to appeal. That appeal process will take, a variety of months. The circuit court appeal could take 3 to 9 months. If they go to the Supreme Court beyond that, it could take even longer. But more near term is what they can ask the circuit court or the Supreme Court basically to stay the injunction, which basically means that they could keep collecting tariffs while they appeal. And so that ruling, well, first they have to do that, which I suspect they will. And that ruling could take, a couple weeks to get determined. Whether or not the court will agree to allow them to keep collecting tariffs or not is unknown. But, we could run up against this 10-day window where they have to stop and then restart. So we'll see. There's another statute that people have been talking about, which is like a section called Section 122, which allows them basically to do up to 15% tariffs really on anybody whenever they want for only 150 days. The reason they didn't do this the first time is because they didn't want to have this clock against them for 150 days, in which case, many countries would just say, yeah, you know what, it's only going to be on it for 150 days. We're not going to negotiate. So that's what the administration felt. That's why they didn't pursue Section 122 in the first place. But they may be forced now into adopting that as the next step. So, but yeah, I don't think we're out of the woods here at all. The administration knows how critical tariffs are to helping to restore trade balance in America, to bringing back manufacturing, to bringing back investment, which is paramount to the administration's goal. It's kind of stated number one goal for the administration is manufacturing job growth here. And it's also critical for revenue generation to help pay for tax cuts in the big, beautiful bill, which is passed by the House, which is being questioned already in the Senate. So I don't think tariffs are out of the woods, but we've reintroduced uncertainty again. And the question will be, how does corporate America, how do consumers react to the potential for either a further reprieve or not? And so we'll be going through that here now over the next couple of weeks and months.
A lot of people are saying that this is a nothing burger. Do you think it's a nothing burger, or is this does this actually potentially change? Like you said, these tariffs are a big part of the administration's plan and what they want to do in terms of cutting taxes, et cetera. Do you think this could stop it, or is just a small little speed bump and doesn't really matter? Or what's your hunch?
I don't think it's a nothing burger. I think we are putting or the court is putting some clamps down on Trump's kind of unilateral ability to do whatever he wants, whenever he wants, which I suppose is a good thing. But there are other avenues that the administration can now more, legally or easily pursue, which is going to allow them to kind of continue the pressure using tariffs as a tool to get what they want. So I think, they kind of went this way to begin with because it was easy to do. And they knew there was going to be challenge in the courts. I guess they were hopeful that the court wouldn't rule this way, even though I suspect deep down they knew that the court probably, would try to put checks on powers at some point. And so now they'll more likely pursue other avenues to get more structural or sustainable tariffs that are not at risk of court interjection. So yeah, I don't think we're out of the woods at all. But on the margin, we've taken off the worst case scenarios, right? The worst case scenarios, which we saw trading and in the economy in the first week of April with 145% tariffs on China, things like that, which people were very concerned about in the supply chains, what was going to happen. We've taken that off the table. The delay itself took that off the table, but I think even now with the court ruling, we've taken off these most egregious left tail economic outcomes. But, tariffs are not going away. They're just too paramount to what the administration's trying to do. And so now it's just about figuring out, how they're going to be implemented more sustainably.
I was just really looking forward to the delay, so I didn't have to talk about tariffs until July. I was really, I was like, okay, finally we got some certainty around tariffs at least. So let's not talk about that until July when all these pauses come up, and then this happens, and I'm like, oh God.
It's interesting you say that. I mean, and from the market's point of view, I mean, one of the things that this overnight tweet risk or not knowing what this guy is going to say or when, has led to a more elevated volatility environment, which has kept, investors on edge, but it's also kept systematic trading flows a little bit more muted than they otherwise historically would have been, which means fundamental data can matter more. And so as you removed Trump's ability to tweet and move the markets, volatility falls, we get releveraging, we see more risk on, crypto has reacted. Stocks have reacted accordingly onto that lower vol regime. And so you're right. I mean, we thought we would be at least, no vol through the middle of July. It kind of was a supportive risk-taking environment. Now we've reintroduced overnight kind of headline risk. How is the administration going to react? How is the court going to react? What's the timeline? So investors now are going to have to start kind of putting this back into their calculus, and it may put some, a stop sign on some of this risk-on trading that we've seen here over the course of the last 3-4 weeks.
Yeah, which I know this is milk or macro, but I gotta quickly bring up that we said recently, everybody, that altcoin season just happened. It happened really fast, and it might be over for now until later on. So I'm feeling even better about that call right now. Okay, let's shift from tariffs. Let's stick with the U.S. economy. Let's shift to the big, beautiful bill. And the setup here is, I'll give the setup, which is that we thought that, I wouldn't even say we thought. There was a point when we were like, oh, maybe we won't need to grow our way out of the U.S. debt. And there might be some other ways to deal with this. And Doge, and there was some excitement around Elon being involved. And then Elon tweeted and said, hey, even as smart as I am and as capable as I am, I don't know what to do with the government spending issue. So, hey, I'm out. Basically, was what he did last week. So now we have the big, beautiful bill, which I just love saying that. I got to give the whoever branded that bill, well done. I'm sure it was Trump. So what's next here for the U.S. economy? Are they going to be able to grow their way out of this? And I think the bigger question is, what's the impact of the big, beautiful bill on stocks and risk assets in the short and long term?
Yeah. And a couple of things here. I think the administration, or part of the allure of Trump and the mandate, of winning as definitively as he did and winning the House and winning the Senate, was that these guys were going to come in and they were going to bring down inflation. They were going to cut government deficits, and that was going to lower long-term interest rates. And that was going to have a reflexive, virtuous ability to help fund growth and, a more prosperous middle class in America. And so, and what they said during that period of time to start the administration for the first couple months was going to be, we're going to go through a detox period. We're going to have a bit of a slowdown. We are going to, see a little bit of a hiccup here as we have to cut government spending and we transition the economy from the profligate spending of the Biden administration to a more sustainable growth of the private sector. And it seemed like that momentum had started and was there. And then it got accelerated by the tariff announcements in early April. And it seemed like, okay, these guys are serious, right? They're really going to actually bring growth down, bring inflation down. It's going to drive yields lower. And we're going to have this growth hiccup here in the first half of the year. And then we're going to transition the economy aided by this big tax cut that's coming later in the year. And then things are going to be better to exit 2025 and run through 2026. It's going to lead to a great election outcome for Republicans and, 2 + 6 more years of Republican mandate, right? That seemed like where they were headed. But look, the market sell-off that we saw in the first half of April, both the stock market and the bond market, really spooked this administration. And it seems as though they kind of abandoned this idea that we could bring yields down, we can actually cut the deficit spending, we can cut the deficit, and things are going to be okay, and we're going to be able to transition. It just sounds like the administration got spooked out on that front. And so we've kind of now abandoned this idea that government spending can be retrenched. And I think to your point, I mean, it was certainly very discouraging. And I tweeted about this earlier in the week, but to see Elon talk about the government spending and kind of his inability to be successful with the Doge cuts, I think is a very telling sign, right? This is a guy who, amongst the smartest people in the world, richest people in the world, basically bought the election, helped get his candidate elected, kind of sitting at the right hand with access to unlimited information and ability to act to really cut spending. And he kind of came away 4 months later and said, hey, you know what? The swamp is deep. I'm not going to be successful. And so, yeah, that narrative, how $1 trillion, $2 trillion of cuts, which no one really, I don't think ever really believed, but just him to kind of come out and say, man, it's a lot harder than I thought, I think is very discouraging. And so Treasury Secretary Bessent kind of has been out over the course of the last couple of weeks trying to instruct or inform people. It doesn't matter. We're going to grow our way out of this debt situation. But look, if you look at the last 80 years of data, there has been no time that the government, that the economy has been able to outgrow its debt growth trajectory without significant inflation or significant asset bubbles. So that's kind of, I think, what the administration is saying is they are going to inflate the debts away. They are going to try to get growth up, and it will be inflationary growth, and they may gaslight us like other administrations have done.
For sure.
So there is no inflation, right? But we know, we can see it, in our day-to-day life, there is more inflation than whatever CPI is telling us in the 2 to 3% camp. And they are going to try to grow the economy with deregulation and productivity gains and tax cuts, and it's going to pay down the debt. But the bond market, I think, has woken up to this fact, right? I mean, so we've seen 10-year yields largely move higher. Now, of course, the last couple of days they've retraced a little bit, but the bond market seems a bit more concerned that the deficit spending is not going anywhere. And when the House passed the big beautiful bill version 1 and seeing $3.5-4 trillion of debt growth and deficit spending, the bond market kind of revolted against that. And so it was passed with a slim margin. It kicks over to the Senate. And now it's in the hands of 5 or 6 fairly conservative, fiscally hawkish Senate members like Senator Johnson, who's been very vocal lately saying, there's no way I'm passing this bill. Ron Paul has said, no way I'm passing this bill. Rick Scott from my home state, no way. A couple other guys. So basically right now, the way that the House passed this bill, there's no way that bill gets passed. And so the Senate wants to see more tangible spending cuts, but the more mandatory spending cuts we do, the more likely that the moderate Republicans, like the woman from Alaska, I'm drawing a blank on her name, or from Maine, and some of the moderates are saying, well, we can't be cutting Medicare and Medicaid spending. Our districts won't allow it. Murkowski and Collins. So we're in limbo here. Kind of how strongly can the Senate push back on what Trump wants to do? And so, but the bond market seems like it has spoken. The bond market does not want to see the big beautiful bill get passed in the way that the House decided to pass it. And so, we'll see. I mean, and that process takes place here over the course of the next coming weeks and months. The president said he wanted a bill on his desk by July 4th. I don't think that's happening, but it's important that they work and get something done, because we do run into an issue in the middle of August on the debt ceiling, right? So, basically the government's going to run out of cash. Well known, well documented. They know the pace of spending. Cash probably could sit with us through to the middle of August. If we lose the tariff revenue, that may get pushed up a little bit. But for all intents and purposes, middle of August, government runs out of money. Something needs to be done. It doesn't have to be a big bill or something, but a debt ceiling extension needs to get done. There's a variety of senators who have never voted for one on the Republican side. So, it's only May 30th. We're a little bit, 2.5, 3 months away, but that deadline sneaks up on us pretty quickly.
Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn. Meanwhile is the world's first licensed and regulated life insurance company built for the Bitcoin economy. They do everything in BTC. You pay in BTC, they pay claims to your family in BTC. You take out policy loans entirely in BTC when you need liquidity. Protect your family from life's uncertainty and a broken financial system. Build intergenerational Bitcoin wealth while the cost of living skyrockets in dollar terms. Plus, get all the tax and legal benefits of life insurance now in Bitcoin. Visit milkroad.com/meanwhile to join the waitlist and get early access to the world's first Bitcoin life insurance.
You mentioned an asset bubble, which sounds bullish. We've seen a few of those in our time, and they can be a bullish thing if you play it right. I'm curious, do we need this bill for that scenario to play out, or do you think that's kind of what they're going to do regardless of this bill? And then just one other question. Do you think they ever actually were going to try and do the whole, like, let's balance the budget and lower expenses? Like, did they actually, was that just like a theatric that they did for a little bit here? Like, didn't they know they were never going to actually achieve that? Or do you think they actually wanted to? Just curious.
I mean, look, a balanced budget is never going to happen. But I think, Bessent came in on this idea of this 3-3-3 plan. And he thought that, we could reduce deficits as a percentage of GDP to 3% by the end of Trump's term, so over 4 years. So basically, we're at 6.5% now, 75 basis points a year, kind of get to that 3 handle by fiscal 28 or 29. And if they did some cuts and we got some growth, I think that was a legitimate, expectation, but it certainly would be back end loaded, and it certainly would need tax cuts and these, real growth acceleration from productivity gains and from deregulation. So balancing the budget, never. But, lowering the spending growth trajectory, I think, was something that they thought they could do. And just to see this House process get done and having even Republicans who have historically been more conservative on the spending just kind of, cave, right? And then Trump, I think maybe some angst about the tariffs and maybe some angst about where the market direction was going, was kind of thinking, look, I just run it hot. It's just easier, right? It's always just easier for politicians to say, run it hot. And, don't make the hard decisions, inflate it away slowly, tell people it's not inflation. And, as long as they have more money in their pockets and we can outrun it, then it's going to be okay. If Trump were to do things like, no tax on tips, no tax on Social Security, maybe reducing all taxes on anyone making under $150,000 a year to zero, arguably he would get reelected, right? Like, it doesn't matter. I mean, you're like, look, I don't pay any taxes. Inflation's a little bit worse, but not such a big deal. So I can understand why he's transitioning to that. But I think they believe that they could control the bond market way more than we actually can. I mean, we've moved past this idea that the U.S. Treasury security is the only neutral reserve asset in the world, right? Foreign central banks are net selling U.S. Treasuries and have accelerated that selling since the early part of 2022, when Russia was sanctioned off, Russian reserves were sanctioned given what they did in Ukraine. And more countries are recognizing that the U.S. could do that to them. And more countries are recognizing that the spending's never going to end. And so they're pulling back from their ownership of Treasury holdings, moving into gold as a neutral reserve asset, bringing capital back to their own countries and investing in their domestic bond market. So, we're at a place here where 10-year yields are 4.5%. And there's pressure here as the government needs to term out some of that debt. That yields are not falling as rapidly as they would have historically, particularly given what oil prices have done, which have been largely come down. So I think there are some concerns there.
Jay, you have a question? If not, I want to ask about the yields.
My question is also about the yields. What's your question about the yields?
Well, so I was just going to say, what is their solution to this? Like, obviously, we've been stuck pretty high for a while now. And last time there was the kind of yippee level people are calling, I think it's 4.5 or 5, whatever it is. They sort of like rolled back tariffs. What's now? Like, just more liquidity? They're going to buy back some treasuries? Or like, what can they do here? From everything I see, it's basically all technically bullish because they're going to have to do something there. What are your thoughts?
Yeah, I mean, Besant was very critical of Yellen and her policies of bills issuance over duration issuance throughout her term, and kind of using that to goose asset prices. And, he said, eventually I'm going to come in and term out the debt. And then the first two meetings of the Treasury borrowing meetings, the quarterly refunding announcement, he basically said, yeah, I'm just going to do what Yellen said to do. And so I don't know how rapidly he's going to be looking to term out the debt like he said he was going to. So that's one thing they can continue to do, is hold back duration issuance. I don't suspect that they're going to cut the amount of duration supply, but they could just continue to kind of hold off on really ever terming out the debt, which would be largely negative for the dollar, more bullish for inflation. But if the Fed's never going to raise rates, which, look, it seems like the Fed is never going to raise rates again. Some people could argue, given the inflation, they should have already been raised. They should be thinking about raising. But they say, look, we're biased to hold or cut, right? So there's an asymmetry here. So if you think the Fed's never going to raise, then you don't really run the risk that borrowing in the short term is really ever an issue. So I suspect Besant will continue on that path. Treasury buybacks are something they continue to do. So far, they've been matching the buybacks. So if they buy back 10s, they issue 10s, they buy back 2s. So they don't really buy back duration and issue more in the front end. That would be something they consider doing. That would be, again, dollar bullish, dollar bearish, inflationary. So that's another trick that they could do. As far as the Fed is concerned, Fed's still doing QT, small, but it is still doing that. I don't suspect the Fed is going to go anywhere near stopping that yet. They still in an abundant reserves regime. There, this ideas of yield curve control and Fed restarting QE. Yeah, look, these are obviously things that they can do when things get bad, but things are not bad. Liquidity is fine. There's been talk about this SLR reform, which is the bank's abilities to buy and hold more treasuries in without risk. Right now, there's really not any risk to banks holding more treasuries, but on the margin, some SLR reform could help enforce some banks to hold more and more treasuries, which, higher demand for domestic treasuries, lower the yield. So, yeah, I think there are things they could do on the margin. But look, I think it will really come down to this bill. How much cutting can we do? What will the trajectory of deficits be? Will tariff revenues act as a buffer here? Will that money come in and help keep the deficits from really exploding? So I think it's kind of TBD. But in the meantime, yields in Japan are higher. Yields in Europe are moving higher. China is potentially re-stimulating again. So could that bring some inflationary pressures? So we're going to have to watch the bond market pretty closely here over the course of the next couple of weeks and months to really see kind of how this all plays out. But yeah, look, if yields really start to move higher, expect the money printer to start up again. And that would be the next, that's when alt season would resume. That's when we could do it. But I think we got to get there first. And every time we have a little bit of pain, it seems like the market forgets the pain. And we don't really ever get to that resetting point. We kind of got some of that in the early part of April for sure. But you saw how quickly they pivoted away from allowing that to continue.
Right. You keep saying dollar bearish and then inflation bullish. I just want to clarify, when you say inflation bullish, because I think our audience might mix this one up a little bit, you mean asset prices bullish, right? Like risk asset prices. And that's your altcoin season, I'm assuming, which is kind of like the 2021 playbook where inflation's going up, but so is all the assets, real estate, crypto, stocks, et cetera. Is that the kind of world you're referring to if everything you just discussed happens?
For the most part. I do think, though, that if the dollar really does weaken materially on back of some of that, we will have more imported inflation. So the underlying inflation, probably doesn't, won't fall down to 2%. It will kind of continue to move higher. Oil prices probably would, rise in that instead of commodity prices move higher. So there would be some absolute reacceleration of inflation as well. But I think the asset price inflation and inflation from wealth effect gains would trump that. So, but yeah, so it'll be a little bit of both.
Are you concerned of runaway inflation in terms of I don't know, we got to what did we get 9% in 2001 or 2021 / beginning 2022? Do you think we reach those kind of levels again? Or you think it's just kind of like a gradual inflation where it's not the end of the world, as you kind of said, for voters to vote Trump back in? Do you think AI is going to play a role to kind of keep this inflation at somewhat of a bay? Or do you think we're going back to 2021 and we're just going to replay that playbook?
Yeah. Look, I mean, I think the high single digit inflation we saw, a combination of, the Russia's move on Ukraine, but even some of the tail end of the supply chain bottlenecks, I think created a little bit of a perfect storm there. I don't expect that we're going to go back to that kind of environment, save, God forbid, something happening on the geopolitical front that, we don't foresee, China, Taiwan, or more, whatever. But I think we'll be kind of stuck more in a, mid, I don't know, 3 to 6% inflation regime, which is, tolerable, but not 2%, right? So it's, your money is kind of slowly bleeding away. And, but if you're making more, you're not getting taxed, maybe you feel like you can outrun it, but it's in that kind of 3, 4, 5% camp, which, doesn't really, and if the Fed if Trump changes out Powell with someone more dovish, which you would expect that's going to happen at least no later than May of 2026, when Powell's term is over, maybe the Fed becomes a bit more tolerant of, a higher inflationary regime. They don't really push aggressively on rate hikes to stop it. And so, yeah, that's, so it's tolerable, but really it's not acceptable, right? If the mandate is 2, and we really never get there, right? We're already at 5 years above 2, and no expectation to get back to 2 until 2027. So at that point, we'd be 6, 7 years above 2. At what point, do people say, the Fed is kind of, full of it here? So, but if that is that an environment where the American populace feels okay, and they're not rioting in the streets, well, I hope so. But we do know how things could spiral quickly. We have a geopolitical event or some issue on the energy front. I mean, look, we're already seeing it. Now the rig count in America has been falling, pretty aggressively over the course of the last 3 months as oil prices have fallen. And so shale oil production has been the largest growth driver of oil supply over the last several years. If we have oil prices too low for too long, big energy in America puts rigs down, and they're not going to put them back very easily. We could have energy prices and oil prices that kind of are reaccelerating, exiting 2025 and into 2026. That would be a problem that I don't think Trump is going to be so happy about. And American consumers paying more at the pump is never something that is good for the incumbent party.
So given the setup right now, Craig, what's your portfolio allocation when you're speaking to, our audience as investors trying to think about how to allocate within their portfolio with all of this noise, with all this uncertainty, but as we keep saying, likely coming back to this inflationary environment, which should be good for risk assets. How do you position yourself right now?
Yeah. So, for me, what I'm most concerned about is low-end consumer continues to get crimped. Small businesses, no pricing power, no voice inside the government, getting squeezed on tariffs, getting squeezed on wages. These are the places to avoid, I think. So, for someone who's looking for asset inflation in the future, and look, I'm a Bitcoiner. I've been a Bitcoiner for a long time, so I remain, kind of long Bitcoin, but I've been hedging that with, shorts in consumer land, shorts in IWM, which is small cap companies. And so, as we try to transition, through this period of uncertainty, kind of having that barbell approach, I think makes sense as we, get closer to this point when we need that liquidity again, right? Right now, I think the Fed is on hold. The Fed's not going to be providing any liquidity. The economy is okay, but it's slowing, right? I mean, there's been some data out now, the hard data, whether it's jobless claims, which ticked up today, continuing claims, which have been moving higher. I've been watching the TSA airline checkpoints daily. Have been starting to roll over. We're running negative year on year. So you're starting to see incremental signs that the hard data has slowed from the beginning part of the year. We know the soft data, the PMIs, the sentiment, the survey stuff plummeted with the tariffs. Is starting to recover because tariffs were delayed. But now we're in that period where hard's kind of falling and soft is growing, and we're going to have to try to find the new equilibrium point. In the meantime, margins and corporate earnings are under pressure. And so that's kind of how I've barbelled. As far as AI and big tech and NVIDIA and stuff, I mean, look, that thematic took a hit earlier this year with the DeepSeek announcements, but it seems like the CapEx trends by the big hyperscalers and the power needs in America they're nonstop. And so I think nuclear related infrastructure is an area that we've been recommending to folks. Power build out is going to continue with us. So there are some really good domestic U.S. themes on industrials and manufacturing, and you kind of sprinkle on the Bitcoin kind of inflation and asset inflation. And look, just the fact that corporates are buying, states may start to buy, and a variety of other new buyers into the space with, limited supply growth.
Here's a buyer for you. Let me throw this one up
Okay.
on screen.
Yeah. Well, exactly. I mean, earlier this week, I mean, it's just, we don't have to, get too closely into it, but look, the family is buying. And I don't know if the government specifically, if the US government's really ever going to start, how they're going to start buying or filling up the strategic Bitcoin reserve. I did see something you guys might know better. I heard we stopped publishing what the US government's holdings of Bitcoin are. I think that was something that was known. I heard that I think that the
they've never known. We don't know.
know.
We don't know. It's all an estimate because it's all through seizures, and all these seizures are like independent wallets held by thousands of various jurisdictions and courts all around America. So there's people trying to figure it out right now and audit it, but we actually don't know what they hold.
Right. So look, I mean, I think that it's a supported asset, by the administration, and it's clearly still very significantly underowned, 2 trillion-ish market cap. I mean, gold's 20, global assets are hundreds of trillions. I mean, so just, marginal, allocations by big portfolios. I mean, Fidelity, BlackRock, and Lights are putting it more into client portfolios. It just seems like a steady, diet of demand here. Look, my understanding is a lot of upside, call sellers playing for yield. I mean, God forbid we ever kind of have a real big move and kind of run over some of those hedges. I mean, we can have a bit of a crash up in the price short term. So, long Bitcoin, long some risk assets, but still hedge with some shorts in small caps, consumer, and volatility. Again, like we talked about earlier, has come in nicely from, where it has been, and even largely where it averaged for the second half of Trump's first term, where he was talking about tariffs all the time. So, being able to buy volatility at the low end of the range here and with, hedging portfolios, I think makes a lot of sense.
What's your time frame when you speak about that? So you're long Bitcoin, long some risk assets, and then short to hedge. Is this a short-term thing, or like if you kind of zoom out and you walk us through your next, I don't know, end of this year into 2026 through midterms? Is this the same playbook you're playing, or do you see that there's things are going to change at some point? Like, what's your sort of more medium long-term vision?
Yeah, I would say that's a thematic that I expect for a bit, but I do think there is a window here in the next couple of months, quarters, where the economy really is showing signs of strain and slowing. The uncertainty around tariffs remains with us. The benefits from tax cuts really are very back-end loaded at the end of this year, maybe don't even kick in until fiscal 26. In the meantime, government spending growth momentum is decelerating. And so there's a bit of a fiscal drag coming for later this year. So where is the earnings growth impulse going to come from? Where is the consumer wallet improving between now and the end of the year? I'm struggling to see it. So I think there's a, call it 1 to 4-month period here through the third quarter. And how many times have we seen in the August, September, October period, markets kind of, get haywire for a variety of reasons. And so that's the kind of my hedge playbook here for the next, few months. And then what I think winds up happening is in that final correction, whatever that winds up being, where that hedge really plays out, you get closer to the government, having to act in some way, or the Fed having to act, right? And so we've started Fed rate cuts in September, or Treasury has decided to really just push the envelope on bills issuance and do no rate, whatever, something that forces one of those actors to really step in later this year. So, and that I think sets the pace for a more inflationary, higher nominal growth environment in 2026 that I think Bitcoin and growth, do incredibly well, and weak dollar assets and hard assets. I mean, I'm long gold as well. So I think that really plays out very nicely into 2026, but I don't think we're all systems go here,
Right.
as we move through the summer.
one more big hiccup, then up only is what I get from this. Because we had like August last year, we had like the yen carry trade unwind, which everyone thought, okay, this is it. We'll puke, and then this is the up only moment. We got faked out, after Trump won. We went up, but then obviously tariffs happened, and okay, this is the up only moment. Still didn't happen. Everyone's kind of waiting for that 2021 moment to happen again. I don't know if it will, but from what I understand, you're like one more hiccup, and then we probably go into that inflationary kind of boom, I guess.
And then the question from there is just, again, on inflation, like how rapid is the inflation? Is it just something that we could tolerate? It's kind of a grind higher. There's some supply side stuff that's good. Energy stays under wraps. More housing hits the market, so housing supply keeps house prices down. That would be a nice environment. The more precarious environment we want, where oil starts to rise, the dollar really gets annihilated, and inflation comes back. Real inflation comes back much more aggressively, and then the administration is dealing with inflation as a kitchen table issue, into the midterms next year, and then gets thrown out, right? And then I think that's a very, challenging environment, kind of having a, more of a Democratic House of Representatives, which just basically puts everything, puts the Trump agenda away. They likely impeach the guy again. And, then there's more of a chaotic structure for, the back half of the term. Then I'd be a little bit more concerned if that's the environment we get. But I think we'll have, not that we'll know it when we see it, but there'll be a run up into it, right? We'll have asset price, things will look good, and all of a sudden people will say, yeah, maybe it's not so good, and yields will start to creep higher again. So that's kind of how I see it playing out.
So pay close attention, because things are changing rapidly right now, and if you think you can predict where this is going, you really can't, because anything can change.
The big thing I would say to people this time versus maybe prior Bitcoin cycles is, to me, the structure of the U.S. bond market has changed from prior cycles, right? And the U.S. Treasury security as the exclusive global neutral reserve asset no longer exists. It still exists, but it's not the exclusive one. Countries are moving away from storing excess trade balances in dollars and in treasuries, and it's actually being supported by the administration. We're talking about potentially taxing foreign capital and a variety of other things. The administration wants a significantly weaker dollar, and I think that's going to lead to a more inflationary hard asset boom environment, similar to like what we saw in the 70s. Look, I think that the bond market is not as much under control as potentially the administration believes. And if we are forced into an environment where the Fed has to do yield curve control again, or Treasury needs to do some soft yield curve control, then the dollar really, becomes in jeopardy. And then we have those much more elevated inflationary environments, which I don't think anyone's really going to love.
So people bring up the 70s inflation all the time. And the thing I always say is, we don't have the demographics of the 70s. So do you really think we can have, maybe what you're saying is sustained inflation, but as you said, 3 to 6%, not, what was it back in the 70s, like 20% or something?
High singles, low double digits.
But that was because we had demographics. The boomers were all getting jobs. They were all buying homes, washing machines, everything for the first time. So of course we were going to have inflation. You're not painting that picture, because there's so many people on Twitter like, oh, we're going to get 70s. I'm like, no, we're not. We're never going to get that.
But that mid-single digit inflationary environment in an economy where the government has 125% debt to GDP, where net international investment position, which is foreigners owning U.S. assets, is close to 75% of GDP, and these massive deficits, it's very different. We are in a worse position now. We cannot handle those types of rates like we could in the 70s. The government just simply can't afford it. So, 4 or 5% inflation that leads to 5-6% interest rates. The government is broke. So either we're going to have to, cap yields or do some massive reset on mandatory spending, or someone's going to have to give in that environment. So we don't go back to kind of those high rates, but it'll feel just as bad, I think.
Gotcha. Understood.
Going to wrap up there. Craig, Absolute pleasure to get you on the show today. Your ability to break this all down is very, very impressive, especially your ability to remember the numbers of all these sections in the U.S. accent. Like you were rhyming off stuff at the beginning.
I've had to
Section
do a little
103.
bit of
I was like, what? Whoa, wow,
I know,
way to
yeah.
go. You're deep, man. Really impressed. Really appreciate it.
I've had to do a little bit of a refresher on some of that stuff, but these things find themselves in the narrative for a couple of weeks at a time, and then they fall away by the wayside. But I try to keep up on, that's what we do at the Bear Traps Report, is try to, understand what the market narrative is, what people are talking about, what's in the news. And we are doing that by chatting with, hundreds of institutions around the world in our buy side chat on Bloomberg and in Discord. So that's kind of how we ascertain kind of what's relevant. And that stuff, that's always, moving. And so we gotta have to stay on top of those things.
Yeah, you said it. With that, I got to remind you all that none of today's show was investment or financial advice. You should only invest what you're prepared to lose, and you should always do your own research and think before you make any decisions with your investing. And if you need help staying on top of the markets, and as Craig said, everything happens so fast, make sure you subscribe to the Milk Road Macro newsletter. Hit the link in the show notes every Tuesday and Thursday in your inbox. 5 minutes to keep you up to pace on everything you need to know. Have a wicked awesome day, y'all. We'll see you back again tomorrow. Thanks for tuning in, y'all. Before I let you go, I got to tell you, our friends over at Gemini are doing a super cool contest right now. They're giving away 2 Tesla Cybertrucks. It's called the Cyber Beast Edition, and it is a custom Cybertruck wrapped in a custom Bitcoin design. It looks freaking awesome. Basically, all you got to do to get an entry in order to win these Cybertrucks is use your Gemini credit card or trade on Gemini Exchange. For every $50 you spend on your credit card or you trade on the exchange, you get 1 entry. So check it out. It goes until June 18th. It's open to US residents 18 and older. So sorry to everyone else around the world. But if you're in the US and you want to get a chance to win a sweet Tesla Cybertruck, check out the link in the show notes. Spend your money on your Gemini credit card or trade on their exchange, and you could win a Cybertruck. And if you win, I hope you come pick me up and give me a ride. All right. Thanks for listening, y'all. See you again tomorrow. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.